Hey guys, it's Akeem here and welcome back to the channel. For anyone that's new, I'm a chartered accountant, or that's a CPA for you guys over in the States, and I currently work in financial due diligence on mergers and acquisitions, and then I also make videos here on YouTube, not to tell people what to invest in, but to try and create an informed community of like-minded investors that we can all learn from really. And speaking of investing, I've just bought a new camera and new lighting and made some general changes to improve production so that you guys can hopefully receive the same quality content, but hopefully now it's a little bit easier on the eyes and ears too. So comment below what you think about the new setup. Anyway, enough of me talking nonsense. Let's get back to what we're actually here for, which is presumably making money, right? And today, I'm going to provide you with 4 killer compounding dividend stocks that can help you achieve your financial goals, especially in this high interest rate environment where I'm sure we're all aware growth stocks are being absolutely slaughtered. Of course, then it's important to add some balance and especially some cash flow generating businesses. Back in September, I released a video where I said that a defensive stock like British American Tobacco would thrive in a high interest rate environment because they generate a ton of cash and they're trading at ridiculously low multiples. 5 months later, and the stock is up 30% with an 8% dividend yield. Now, I want to preface this by saying that I think most people are aware that whether a company pays a dividend or not doesn't actually matter to the long-term returns of a stock. A company can not pay dividends, instead choosing to reinvest the excess capital into the business, funding further growth and thus appreciation of the share price. Take Amazon or Netflix, for example. Conversely, a company can choose to use that same excess capital to pay dividends, providing the investor the choice of where to reinvest and grow their portfolio that way, effectively using the dividend snowball method. It's also worth noting that the best dividend stocks aren't necessarily the ones that have the highest dividend yield. In fact, it's actually an indicator that the market doesn't like the long-term prospects of the business. So you should be aware of that, right? For example, a 20% dividend yield is only that high because the market is literally pricing the stock that way. So with all of that in mind, the first stock on the list is Johnson & Johnson. The company doesn't really need an introduction, right? They are the epitome of a household brand, and I would be willing to have a bet with any of you guys that if you take a look in your bathroom cabinet, you're going to find their products, which is what makes the business so strong, even in times of an economic downturn, right? Even if we enter a recession, people might cut their Netflix subscription, but they won't stop looking after their health. Now, Johnson & Johnson are a $430 billion company, so they are by no means small, and they're trading at $163 a share, and they currently pay a dividend yield of about 2.6%, which might not sound that special, but their payout ratio is only 53%, which, by the way, is calculated as dividends paid over net profit. It provides a measure of basically how sustainable that dividend is. So with a payout ratio of just 53%, it's safe to say that it's quite unlikely for Johnson & Johnson to have to cut that dividend. And in fact, it suggests that they're likely to continue increasing that dividend over time. Not only do they pay a solid dividend, but the growth of the business is really consistent as well, which makes valuing the business so much easier. In addition to that, using TIKR Terminal, I have access to 15 years of historicals and 5 years worth of analyst estimates going forward, which once again makes my job a hell of a lot easier. Now that allows me to identify one of the great things about Johnson & Johnson, which is that their EBITDA margins have been consistently improving, going from 31% in 2010 to an expected 40% in 2026, meaning the business's profitability is improving, which tends to result in higher valuations. Now, if all you did was focus on revenue growth, then well, you wouldn't catch that. Okay, so the next stock on the list is Intel. So I don't know if you've noticed, but Intel has been having a pretty rough time over the last few years because let's be honest, right, AMD has been eating their lunch and Intel only have themselves to blame for that. Management got complacent, underinvested in research and development, which meant that they fell behind in terms of the performance of their chips. It feels like Intel have been working on their 7nm chips forever really, which they still aren't expecting to release until 2023, whilst Dr. Lisa Su of AMD recently announced that they're expecting to release their 5nm chips in 2022. So why do I think that Intel is a good turnaround story? Well, first of all, we often find good returns when a market is overly pessimistic about a stock. Mr. Market is extremely emotional and often irrational, which leads to exaggerated swings either for or against a stock. But the truth with Intel is that whilst they've had a horrible past few years, they're making the changes today to right those wrongs. They've replaced the CEO with Pat Gelsinger, who actually understands engineering in depth, unlike his predecessor, and they're committing to significant amounts of investment in the business. They plan to spend over $25 billion per year on capex for the next few years to build out their fabs and bring the manufacturing of chips home to the US. no longer relying on Taiwan Semiconductor. Now moving on to the financials, Intel is a $180 billion company, currently trading at $45 a share, which by the way is a 52-week low for the stock, with $28 billion of hard cash on the balance sheet. And for a business that is apparently dying, well, they generate free cash flow like it's not even funny, right? Their 2021 free cash flow fell by almost 50%, which by the way, a lot of that was driven by increased investment in the business through CapEx. And that still only brought it down to as low as $11 billion, or around an 18 times enterprise value to free cash flow yield. Free cash flow for 2022 is expected to be close to neutral, which again, on the face of things, looks like an absolute disaster. But when you remember that that's because they're investing $27 billion into the business to drive future growth, the more you should probably start to get excited. The current dividend yield is around 3%, and over the past few years, the business has been buying back on average about 4% of outstanding shares each year, effectively giving you a 7% return without even taking into consideration changes in the market cap. Now be aware that this will almost certainly decline in the short term to allow the business to continue investing aggressively, but the long-term outlook is pretty interesting. Management have guided for 15% revenue growth from 2023 onwards, which for a business trading at an enterprise value to EBITDA multiple of just 5.5 is absolutely crazy. All right, so the third stock on the list is one of the largest corporations in the world, and that is Microsoft. I think we can all agree that Microsoft needs no introduction. And now I realize that I've said that a couple of times now, but I think with Microsoft, we can definitely agree on that one. They're so diversified that the company kind of feels like an ETF, having business streams in personal computing, workspace collaboration, cloud computing, gaming, and whatever else that they're into. And over the last couple of years, the stock has seen some incredible gains as a result of that perceived security, up over 100%, taking the stock from a $1 trillion company to a $2 trillion company. In 2022, however, the market is beginning to offer investors the opportunity to get back into the business at a more reasonable valuation now that they've fallen by 14% in just 2 months. Microsoft has a dividend yield of just 0.8%, so don't expect any huge payouts each quarter with this one. But with a payout ratio of just 25%, the stock is all about the dividend growth as well as the capital appreciation. Now, despite the size of the business, and to give you some perspective on that size, the company has over $125 billion in cash on the balance sheet, which is just almost unbelievable. Right? It's ridiculous. Now, revenues are growing at over 18% year over year, and profitability is continually improving as well, with EBITDA margins going from 43% back in 2010 to an expected 51% in 2025. Now, considering the ever-improving security of the business and the strength of its fundamentals, it's hardly surprising to hear that the stock is not exactly cheap right now. Trading at an enterprise value to EBITDA multiple of 23 puts it slightly above its 5-year average of 20. With that being said, I ran the numbers in my full valuation of the business in a previous video, which I'll link in the description somewhere below, and I arrived at a fair value of around $275, which is basically where it is right now. And as Warren Buffett once said, it is better to buy a wonderful business at a fair price than a fair business at a wonderful price. And I would bet that there aren't many people that will argue that Microsoft isn't a wonderful business. Then finally, last but definitely not least, is of course British American Tobacco. Now, the first thing that people say when I mention British American Tobacco is, why would you invest in a business or an industry that is clearly dying because literally nobody smokes anymore? And I find that quite amusing, right? Because it sort of demonstrates how people make assumptions based on the small bubbles that they live in rather than based on facts and figures. The truth is that whilst global tobacco use is declining, the rate of decline is not nearly as drastic as what you might believe. And still, even today, almost 1 in 4 adults smoke globally. In fact, over 5.2 trillion cigarettes are consumed annually. That was trillion, not billion. It's a long, hard road until cigarettes are no longer around. And in the meantime, British American Tobacco is generating a ton of free cash flow along the way and passing that on to shareholders at a yield of just over 6%. Not to mention their transition to non-combustibles, which is growing at a very fast rate and is expected to generate revenues of $5 billion by 2025. Now, British American Tobacco, and to be honest, the other tobacco manufacturers as well, have incredible pricing power, and they've done a fantastic job of increasing revenues and margins over the years. Back in 2010, they had revenues of $15 billion with an EBITDA margin of 40%, which by the way is a very strong margin, and they were able to increase that to $26 billion in 2021 with 46% margins. By 2025, those revenues are expected to be $30 billion and EBITDA margins sitting pretty at 50%. Once again, higher margins means higher profitability, which tends to mean higher valuations. On top of that, they'll reward you with a 6% dividend yield whilst you wait for the capital appreciation. Anyway guys, I hope you've enjoyed the video, and if you have, please leave a like and drop a comment down below with what dividend stocks you like the look of. And until next time, thank you.